Guys, Frank Cappelleri from Cap Thesis. It's a pleasure to be here with you again here on Stockcharts TV. So today we're going to look at three specific S&P 500 charts to give us a clue about the S&P 500's next move. Then we'll look at an update on our pattern work, which we talk about every time. And then we'll discuss a few ETFs outside of the S&P 500, and then finally look at a few recent trade ideas. But before doing that, I wanted to review a feature on Stockcharts.com that I find extremely helpful and a great complement to the charting itself. That is the historical price data. I use it anytime there is an extreme move in the market, either on a daily basis or a course of a few days. And as we can tell, over the last number of months, this has been an extremely useful tool along the way. So if you go to the Sharp Charts page here, on any index, ETF, stock, and scroll down to the bottom left, here is the historical price data. Click that, gives you all of this data. And I usually view all historical data just because it zooms everything in. As we can tell, we can view this on a daily, weekly, or monthly. So if you were to click download data set, this is what it kicks back. So the date, of course, going back over 50 years now, open, high, low, close, and volume. And so what I do from that point is I just have a pretty simple macro in Excel made, and by clicking that, it produces this. So I like to look at things in terms of percent moves, as you probably tell from this angle, and just looking at this, of course, negative being red, positive being blue, gives us a pretty good indication of what's going on a day-to-day basis. So I recently used this toward the end of April when the market was coming back in a very strong way. The S&P logged 3 straight gains of at least 1.5%, which seemed to me, just witnessing it live, it seemed like something we haven't really seen too much, and was a cluster that I wanted to take a closer look at. So again, using historical price data, downloading it to here with the SVV file, using a macro, and then taking a closer look, this is what it produced, right? So these were the instances going back to 1970 where the S&P was up at least 1.5% for 3 straight days. And as you can probably tell by looking at some of these dates, pretty much lined up some of the time, at least, with key market lows. And so data is one thing, but of course, anyone who's viewing this channel probably likes charts. And when you combine data and charts, that's when you have an extremely powerful perspective, and it gives us great context as well. In fact, this was something I used as a feature in one of our opening look pieces on April 25th, which I wanted to show you right here. So if you go to capthesis.com, the newsletter section, we have all of these together, including some videos as well. And so going to the opening look piece from that day entitled 3 straight 1.5% gains. And so one of the things we looked at that day was comparing April 2025 to August 2024. We were talking about how the comeback looked similar. And of course, after the August bottom, it led to numerous months of gains. So getting to the 3 straight gains of 1.5%, again, this is the table. And then I took that and was able to, of course, use the Stockcharts.com charts and look at each one of these. And so a few takeaways, which I thought were very interesting. Number one, nearly every time the S&P was meaningfully higher 12 months later. That's not a surprise, of course, but two other things that was really interesting was that there's only one real failure. It came in 1973, with it happening within a longer-term downtrend, which continued. But the one that really struck me, and again, I wouldn't know this unless I looked at this on each chart as well, was that all but one of the instances began with the index trading below its 200-day moving average. And if you recall, that was one of the negatives as the S&P was coming back, because it was still trading beneath the 200-day moving average. And the last time that it undercut it on a long-term basis was in 2022, and that lasted for a long time. But showing this, when you have strong moves after a big downturn occurring underneath the 200-day moving average, just a matter of time before the S&P gets back above it. So here are some examples. This is the most recent one that occurred right after April 24th. The S&P was trading right around not even 5,500 at the time. So we know that, of course, that market's been rallying much more than that over the last number of weeks. So the only time of all these occasions when this particular instance of 3 straight 1.5% gains happened with the S&P already above its 200-day moving average was in 2021. All the other times it occurred below. So going through a few of the previous ones, 2016, February, marked the low, just around it. Going to 2011, happened right after, at least, the low in October 2011. Now, as you will see along the way, it's not like the market was straight up from there. We still had to endure some volatility, but this type of really strong move over 3 days tends to happen after a good amount of the damage is already in play. And that's what kickstart momentum in the opposite direction. Moving further back, 2002, it occurred in August. Now, again, this was a lot of back and forth movement going all the way to, another 9 or 10 months at that point. But again, the S&P didn't get much below that area. So coming at much closer to the end of that downturn from the internet bubble bursting than the beginning of it. Going to 1987, it occurred twice right after the crash, and then again in December. As we know, anyone who traded it at least, this was not easy to sit through, but it did occur after the crash happened. Looking at 1984, right at the low. So it started beneath the 200-day moving average, and by the time those 3 days ended, it was back above it, and off we went at that point. 1982, right before the low. So we had to undercut that just a bit, and then off we went again once more. And then again, 1973, 74, very close to the low. 1973, we had just talked about, that was the only time that it happened within a downturn. So again, combining stats like this, after extreme moves with charts, Stockcharts.com offers all of these ways of looking at it to help us better identify what type of market that we're in, and of course to help us leverage that from our own personal portfolios. And if we're have clients that we help keep informed, like I do, of course, it's been extremely helpful. Now again, the crux of our analysis is always chart patterns, but by combining all the other charts and indicators, it gives us a better understanding or increases our conviction level sometimes for these patterns. And so the first one is just looking at the trading boxes. Now, this could be considered patterns as well, but we like the simplicity of this, right? We're really just putting boundaries around trading ranges and understanding that the market pauses along the way. Now, it's been a slingshot higher, right? The S&P is up 25% from the lows, and many other stocks and ETFs are up more than that. But along the way, as we can tell, it has paused for multiple days and weeks at a time, even in April and May, and now in June. And so just tracking how these trading ranges get dealt with. Breakouts now 3 straight times, potentially 4. Now, if we finally see a reversal of this very short-term one now, as the market has slowed down, that could tell us maybe momentum is starting to slow down. Maybe things are now due for a greater pullback, right? So this is going to be a very good tell as well, as it was around here in October, November, and of course, the huge trading range, which the S&P couldn't break out of from November all the way to the end of February, March. Now, in terms of momentum, there is a sign the momentum is slipping. That's looking at the 14-day RSI. And so with the 14-day RSI making lower highs, as the S&P is making higher highs, that's a classic negative momentum divergence. And as we know, it's a warning sign, not a signal. But that warning sign ended up becoming a very good signal just a few months ago, as the S&P was making marginal new highs from December all the way through February. RSI did not get back to overbought territory. Last hit overbought at the beginning of December. As you recall, December, at least the first half of it, was characterized by big cap or large cap tech leading, and we had those 14 straight days of negative breadth to start the month for the S&P 500. So that resulted in momentum slipping again, and eventually that did indicate that the foundation was crumbling to the point where, of course, the market then fell apart. We know the reasons for it. At the same time, there was some other indications that we reviewed in the past, how bullish patterns started to fail over and over again for those 4 or 5 weeks, combined with a weakening momentum that gave us the indication that at least the character was changing once more. And we saw that as well on a weekly basis, which took a much longer to play out last year. So the RSI last hit overbought territory on a weekly basis back in July 2024. And even though the market came back and of course started to made new highs all the way until February, the RSI was making lower highs. Now, it wasn't falling apart, staying close to overbought territory, but it was just noticeable. And so we talked about it at the time, understanding that price action itself is more important than indicators or momentum. But eventually, what started to occur? We started to have trouble getting back up and breaking out, as opposed to every time before that, breaking out to new highs has led to more new highs. And eventually, again, noticing that bullish pattern started to fail during that time frame, gave us the indication that maybe things were changing. And of course, that ended up happening over the next few weeks. And lastly, MACD, right? We're looking at the last MACD sell signal, which you had talked about before, coming after just an extreme move in the indicator, and really any indicator over the last few weeks, getting to exceedingly oversold, or however you want to look at it. And then, of course, getting extreme to the other side now, with the pendulum completely swinging to overbought territory. So just simply slowing down at any point would have caused this sell signal to occur. But as we can tell, while the moving average is hugging the lines, they really haven't budged from each other either. As we can tell in the past, when we've seen these sell signals occur, those lines will separate, with the faster line going underneath the slower line, that producing the real sell signal. As of now, that hasn't happened, and the S&P is now a good deal higher than it was last time we had the sell signal. And that makes us think that potentially we could be in one of these phases where the buy or the sell signals that failed, highlighted in blue here, just indicate that investors are willing to buy the dip or continuing to buy the dip. But as we can tell, all along here, all these sell signals occurred 5 out of these 6 times from September all the way to February. They didn't work out. They were just whipsaws. So it tells us that mean reverting move strategies weren't working at the time. Once that changes and we have a few of them happening together, or start to work more often than not, that could tell us again that maybe this uptrend is changing. It hasn't happened yet. So that'll be something we want to look for as well, if that does in fact change. So from a pattern perspective, we show this pattern grid every morning to our Cap Thesis clients, just to give us just a quick glimpse of what's going on. Because as we know, if we have a lot of bullish patterns working, or more bullish patterns in play compared to bearish patterns, it tells us that the market is in an uptrend. And since April 7th, there have only been bullish patterns on this grid, which of course is another reason why we have remained on the side of the uptrend. So here they are, and we'll review all of them right now. So we had that marginal breakout just beginning stages of June, on June 3rd through 59.50. So this one, of course, is tentative, right? At any point, if we get a big downturn, maybe to the Fed, of course, some geopolitical tensions and so forth and so on, it's going to be violated. That wouldn't be a surprise. But if it doesn't get violated and we actually see that upside target hit of the smallest pattern overall, that would tell us even more so that there is extreme interest even to buy the smallest dip, right? That could just tell us that it's underlying technicals are stronger than we even think they are, right? And so we'll have to see how this one plays out. And if it does get violated, again, there are other ones in play that this can then be morphed into something else. And so going back to that April 25th time, right after those 3 straight 1.5% gains, produced one of the biggest breakouts we've seen in this cup and handle pattern, with the target all the way up to 61.25. As we can tell, as the S&P is continuing along, it's gone further away from that breakout zone, which then increases the confidence of this actually playing out eventually. And then just a few weeks ago, the breakout through 65.55, again, continuing higher. This one hasn't been tested at all. So again, we respect these breakouts for as long as they remain in play, so their targets will continue to be with us as well. So the targets, to get back to this table, are important, but not nearly as important as understanding or realizing that these breakout zones continue to hold. So currently, the S&P is still about 5 or 6% above the 56.95 breakout zone, which produced a 65.55 breakout target. More importantly, the breakout that we got on April 25th, the S&P is still 9% above that area, which means it can back and fill a lot at this point, and almost go into correction mode and still be above that breakout zone, which means it has a lot of leeway to back and fill And on the most bullish side, if we do see a greater pullback, it can then form other bullish patterns on top of this one, which can then end up playing out into the summer months. And something to we'll have to look at if and when that occurs going forward. Now, from a bearish pattern perspective, keep track of these as well because it gives us just as much insight. So along the way, this is just a raw chart of the S&P. It looks like just a classic V bottom, right, from one extreme to the other, now all the way back up to top. But as we just reviewed, there are a number of bullish patterns in play here, and also some bearish ones over the last few weeks, where we have arguably two pretty substantial rising wedge, which are bearish patterns. We got the breakdown potentially at the end of May, which of course was short-lived, and then another one then got created, which of course was also broken down. Still haven't had any downside follow-through just yet. That's very telling because on the way down, right, that wasn't the case. And we had the first real rally attempt from mid-March to late March. This actually ended up looking more like a bearish flag pattern. Could have called it a rising wedge as well. Regardless, we know all along the way, any type of pause was resolved to the downside. Could have put trading boxes on those as well. But just understanding that concept that has been different so far, that's very telling as well. And from a classical bearish pattern perspective, if we continue to fade near 6,000, it could definitely pull back to say 5,800. As we know, that's been a very important spot going back a number of months, both as resistance and support. And that could then maybe produce a reversal pattern. And if that is the case and that ends up playing out, and then eventually maybe those breakout zones will be violated. These are all one or two steps ahead, but things we're thinking about if in fact things change. Now, looking beyond the S&P 500, as we know, technology has been a huge part of this comeback. And XLK Technology ETF on Monday, June 9th, pushed above February high, January high, which means it also made a new 52-week high and a new all-time high. And to do that, it had to rally almost 41% in about 9 weeks to get there. So considering that, it's extended, of course, to right back to resistance where it had trouble before. That could be perceived as a classic bear setup, right? If we are going to see a mean reverting move. But, what are the odds that this is just the first leg of this rally, which would be pretty substantial if this continues. But, if we go back to 2018, we've seen that before. How many times? 3 prior times coming after 3 of the biggest downturns over the last number of years. Coming back from the 2018 fourth quarter bear market, and we know that the market snapped back to there, kind of paused in the beginning stages of 2019, in the middle of it as well, finally got the breakout. Same thing with COVID, same thing after the 2022 bear market comeback, right? And so looking at that, you can tell that the second leg or the breakout or the move after the breakout, after getting back and through those former highs, was just as substantial, if not more so, and lasting for longer. It didn't have the necessary acceleration that we saw at the beginning stages of these moves, but that's how uptrends then get created. That's how the market matures from having a huge amount of movement from the very beginning to cleanse itself from the previous volatility to eventually getting to the point where you have a more consistent, more trustworthy and non-volatile market with even in XLK Technology ETF. And of course, not just XLK. XLK has been helped a good amount by SMH Semiconductor ETF. So it also is at a very important spot short term. Getting back to that 260, 265 area, which it failed at in January, not even February. And that was actually discouraging because this was a pretty picture perfect potential cup and handle pattern, which only had about 2 or 3 days of follow through. So now it's trying again. So we can argue this isn't as clear of a cup and handle pattern, but as we can tell, any part of this could be considered, a higher low. The other part of it is that if you look back now over the last year, SMH is net flat. I would say arguably it's in much better shape now than it was 12 months ago, because you think about what was going on, you had this huge run up, right? From May to June into July with really no break, right? That was extremely extended back then. NVIDIA was going berserk along with some other stocks that had no break. And so if someone were to tell you in 12 months, you'd have to go through intense volatility and the SMH would be right back to where it is right now, would you want to buy it then in 12 months? It would be exercise in patience, of course, or now, right? 12 months ago. So I think that the answer is it looks in better shape now after having come back from all that, after having taken all those punches and getting right back to where it was or close to where it was before. And that's how things can extend further, even though it seems to be very extended short term. And so there's been some recent trade ideas we provided for clients based on some of this action we just discussed. One of them being that SMCI, very polarizing stock on the way up in 2023, 4, and even at the beginning stage of 2025, since then settled down a bit. And now over the last few months has produced pretty clear inverse head and shoulders pattern, and actually two of them. One that's been taking place or trying to take place over the last few weeks, one that of course is a few months old. So if it eventually can get back above this zone, it will produce an upside target, a measure move of 63, which is very close to its former highs right there, right? And so it doesn't seem likely maybe because of how volatile it is, but at the same time, it's a pretty clear pattern in that we just feel we had to at very least relay because our clients should know about it. And when we put in these chart trades, we always have a suggested stop losses. And from a classical pattern perspective, we always put this right around, say, where the right shoulder is on an inverse head and shoulders pattern, or where the handle is on a couple handle pattern, because from our perspective, if that zone is violated, it just nullifies the structure of the pattern that got us into the trade in the first place. So this is why we always give, again, suggested stop losses around those same areas. And so on a weekly basis, log chart, we can tell that getting through that same breakout zone, right, 45, 47, but also put SMCI above a very key long-term trend line as well, something that it's failed numerous times at all along the way. And that will be the next step, getting back to the most recent high and, going all the way back to early 2024. That will be way, way into the future if and when that happens. But again, it can only get there if it starts to leverage bullish patterns once more. So AMD had a huge move on Monday, June 16th as well, right, up 9%. So we don't recommend chasing stocks that are doing that after one day. At the same time, you can see that it also has logged inverse head and shoulders pattern here, produces a potential breakout target near 168 if it can stay above that. And that would line up, right, with the 61.8 Fibonacci retracement level, which is right around 170. And so when you have a bullish pattern target line up with another key reference point like that, it just gives us a better idea that it could potentially get there, right? There's maybe two magnets pulling it as opposed to one, but it still needs to hold this breakout zone for that to occur. And it may not. It's up a lot over the last number of weeks. It just may need to have its own additional consolidation period then, which maybe could take place, around 120, down to 110, so forth and so on. The point being is this has been a comeback story ever since it topped at the beginning stage of 2024. And the way to get back up there, very similar to SMCI, is just to continue to leverage bullish patterns. Now, we're also looking for, or we identify bearish patterns when they occur as well. And just going through some of the names in the S&P 500 just the other day, this one in EXC, which is a utilities stock, really caught our eye because it's pretty clear, right, in terms of this being a bearish or a potential bearish pattern, this being the left shoulder, the head, and the right shoulder. This is a pretty simple theory, breaking below that neckline then would produce a measure move down to 37. And with there being very light support to that point, momentum could take over as well. And we can talk about the reasons why this should and shouldn't happen in terms of being utility and how utility is sometimes is correlated to bonds. But at the same time, sometimes it's just good enough to simply identify the pattern, understand where it is, and understand the risks involved with it as well. So that's the update for today. Again, I would really urge you to check out the historical price data on Stockcharts.com. A huge compliment to their very powerful charting platform. Thanks. I'll talk to you soon.